What if the most expensive financial mistake of your life doesn't feel like a mistake, but like the safest decision you could make? Imagine two people starting at the exact same point. Same age, same salary, same city, same $5,000 invested at the worst possible time in the market. One panics and waits for things to calm down. The other keeps investing, even while everything looks broken. 10 years later, one barely moved forward. The other completely changed his financial future. Same starting line, radically different finish. Why? Turn on the news during any crisis and everything sounds urgent. Markets are falling. Experts sound worried. Headlines scream uncertainty. Your brain instantly translates this into one message: protect yourself. But here's the uncomfortable truth. The moments that feel the most dangerous are often the moments that create the biggest opportunities. When prices fall, it feels like something is wrong with the world. In reality, markets react emotionally in the short term and mathematically in the long term. Across decades of market history, crises always feel unique while they are happening. Oil shocks, recessions, wars, pandemics. Each time it feels like this time is different. But when economists analyze long-term data, a consistent pattern appears. Downturns are temporary, while growth compounds over time. Markets historically spend far more time rising than falling. Yet most investors make their biggest decisions precisely during the falling periods. Is that logical or emotional? Behavioral economists discovered something fascinating. Losing money feels about twice as painful as gaining the same amount feels good. Your brain isn't designed to maximize returns. It's designed to avoid danger. That means when markets fall, your instincts push you to stop investing. Exactly when prices become more attractive. The biggest enemy of long-term wealth isn't the market. It's emotional decision-making. Think about the companies that dominate today's economy. Many of them looked risky or uncertain during major downturns. Periods of fear often create discounted prices for strong businesses with long-term growth potential. Ironically, the best investing environments rarely feel safe while they are happening. No one can predict short-term market movements consistently. Anyone claiming certainty is usually selling something. But long-term investing has always relied on three principles. Consistency beats timing. Diversification reduces risk. Time in the market compounds results. Simple concepts. Difficult execution. When uncertainty increases, investors typically face three choices: sell and wait for clarity, do nothing and hope for stability, continue investing systematically. Only one of these options historically maximized long-term results, but it also requires the most discipline. The challenge isn't knowledge, it's behavior. Zoom out far enough, and markets show a persistent upward trajectory despite temporary shocks. Short-term volatility creates noise. Long-term investing creates signal. The difference between successful investors and frustrated ones often comes down to one question: do you react to headlines or follow a strategy? Two investors can start with identical resources yet end up in completely different financial positions. Not because one is smarter, not because one has insider information, but because one understands how emotions interact with markets and plans accordingly. Opportunities rarely announce themselves clearly. They usually look like uncertainty. The question isn't whether volatility exists. It always will. The question is whether you're prepared when it appears. If this perspective helped you see markets differently, subscribe for more content about smart money decisions.